Thank you all for joining us today, and welcome to the Cedar River Capital Third Quarter 2020 Market Touchstones Update Report. My name is Paul Latta. I have with me my business partner, Baj Kochar, and today we will indeed be talking about market touchstones, the things we believe are the most important factors driving markets today. So please join us as we dig into more detail on each of these touchstones. But let's begin by looking at an overall overview of the market investment landscape today. Today's investment landscape can be summarized with the old investment maxim, don't fight the Fed. Clearly, we've had a very sharp economic contraction in the second quarter year, GDP down over 30%, a breathtaking contraction, and yet the markets are rallying anyway. What's with that? Well, clearly that's Fed policy. The Fed has stepped up with uncapped quantitative easing and has been buying bonds of all stripes in the market since late March. It's also dropped interest rates to zero, and you sum that together and that's what we have. We have a market rally. These are the three main topics we'll be talking today, just putting a little bit more context around the COVID situation today, more context around Fed policy, as well as more context around the market rally. We'll also talk about some of the other factors going on, probably the most important of which would be the upcoming presidential election, and some other factors, stocks versus bonds, which sectors are leading and whatnot. So stay with us. Let's go ahead and start with a little bit more detail on the COVID-19 pandemic. This chart here is just a slightly different way to look at the COVID situation. It seems the conventional approach to looking at the COVID situation is to look at the number of deaths or number of infections. In fact, most of us, if we are looking at our news websites every day, that's frequently what the Reuters News or AP Newswires are actually leading off with, a number of deaths or number of infections. The challenge, of course, is with number of infections, it's a very uncertain number since, well, a lot of people are asymptomatic, or people that might be symptomatic but might be afraid to go to the doctor, or might be minimally symptomatic. So quite a bit of uncertainty in the actual number of infections. The number of deaths would seem to be more certain. Certainly a death is very certain. The problem with the death number, though, of course, is when a patient may die of COVID, they may also die of perhaps an autoimmune condition like the cytokine storm or a kidney failure or one of the side effects of COVID. And so the actual cause of death might be listed as kidney failure, or it might be listed as COVID. And there's not really a consistent approach across states and even across individual doctors. And so the death number itself can be uncertain. So quite a bit of discussion about this amongst my biotech friends, and one of them suggested from a friend of his, biostatistician over at the Fred Hutchinson Cancer Research Center, that instead of looking at number of deaths and number of infections, just look at all-cause death rate in the U.S. and see if it's changed. Well, indeed it has, and so you can see in April of this year, we've had about a 40% spike in overall all-cause death rate. The good news is that number is declining now, so it appears that the social distancing and other measures are having some positive impact on that big spike. Good positive for hospitals and the risk of overwhelming the hospitals. But clearly, though, even though there's quite a bit of uncertainty and a lot of politicking around the COVID death rate and the COVID infection rate, the all-cause death rate does sort of latch this down as to how big the problem is, and so we can kind of get our arms around here with just a slightly different data set here. Anyway, I think it's just an interesting way to look at the COVID pandemic, a slightly different approach from what you might see in the news, and it does suggest that indeed we do have a problem that's still ongoing. In our prior slide, we showed that the all-cause death rate in the U.S. was starting to decline. In this slide, we show, at least in the picture on the left, that the U.S. experience is not necessarily the same as the rest of the world experience. This one charts confirmed cases by area, but you can see that it peaked in July, and the numbers have been starting to decline since then, almost cut in half from its July peak. But India has been seeing the numbers escalate persistently week by week by week with very little break. Europe, in contrast, we see that it spiked up in April, declined over the course of the summer, but then in the tail end of summer, it actually started to escalate and is back up to record levels. 3 different regions of the world, 3 very different experiences. So each area of the world appears to be experiencing its own journey. Interesting. Table on the right, just a little bit of context here, just showing confirmed deaths. Sometimes the U.S. looks like it has a very high death amount, but it's actually just the total deaths are higher because the population is higher. The death rate is actually not out of line with other countries. They're at 58 deaths per 100,000, and you can see some of the Latin American and European countries right there in the low 60s. It's a fairly comparable death rate. I found it sort of inspirational that there's over 200 vaccines in clinical trials right now at the pharmaceutical industry worldwide. And that's despite the fact that the antiviral economics are not particularly positive. And we've seen this before with the Gilead hepatitis C situation. It may start off strong, but when you cure all your patients, that's a tough business model. And of course, with the humanitarian crisis, prices are probably not going to be particularly elevated, so profit margins are going to be pretty tiny. This is really a humanitarian effort more so than a capitalist effort here. And so I find that inspirational. 200 vaccines, most of which are not going to be making a whole lot of money. In fact, most of them are probably going to be losing money. It's also interesting that while there are many candidates, there's not that many categories of candidates. And you can see here in this table that there's four and a half categories: the RNA, DNA vectors, there's the viral vectors, the protein subunits, the attenuated virus, and then of course the last category of everything else. And when you look at the leading candidates today, maybe the top 4 or 5 candidates in terms of who's likely to get approved first, not necessarily in terms of who's going to be best, but in terms of who's going to get approved first. Well, the AstraZeneca drug is a viral vector. The Moderna and Pfizer drugs are both RNA vectors. The 2 Chinese drugs right behind them, those are attenuated virus. And so we're sort of sprinkled throughout. There's not a category that appears to be leading. It seems to be we're moving forward on all fronts at the same time, which of course is what you would expect in a situation of humanitarian crisis. And I just find that inspirational. One of the single most asked questions about COVID is, when are we going to have a vaccine? And of course, as we saw from the prior slide, there's a couple hundred vaccines that are under development. And we're probably not going to have a vaccine. We're going to have multiple vaccines, but that will take some time. When are the first vaccines going to make it across the finish line? How's the horse race shaping up? Well, that's what this slide is here. And these are basically listed in rough order from top to bottom, with the AstraZeneca University Oxford vaccine, AZD1222, at the front of the list. Now, unfortunately, about just a few days before this chart was put together, a few days after this chart was put together, AstraZeneca did have an adverse event in their trial, and so the trial's actually gotten held up a little bit. So that one may have dropped a couple of places in the horse race. So probably the Pfizer, BioNTech, and Moderna drugs are probably number 1 and number 2 now. Although I don't think AstraZeneca's dropped far on the list. They're probably still in the top 5. Probably still going to have something out, perhaps by year end. Anyway, just because I think Moderna and Pfizer, BioNTech are at the front of the horse race doesn't necessarily mean they're going to have the best vaccines out there. But the likelihood is they will have clinical data within the next couple of months and an emergency authorization, perhaps by year end, assuming the clinical data is supportive of such an authorization.
Moving on from the COVID data, we'd like to take a few minutes to discuss the Federal Reserve and its response to the COVID pandemic. In the second quarter, we saw a breathtaking GDP decline of 32%. It was the largest quarterly contraction in economic history, and it was a larger GDP contraction than any of the annual declines that occurred during the Great Depression years of 1929 to 1932. In response to this, the Fed ran its printing presses fast and hot, so to speak, with the objective of flooding the markets with capital and stabilizing the debt and equity markets. The strategy appears to have worked, at least with respect to ensuring the orderly functioning of the financial markets. The Fed's effect on the actual economy is debatable, and the long-term effects of such aggressive quantitative easing are still unknown. It is possible the Fed's policy could spark inflation or significantly weaken the dollar. The Fed has also further inflated the government and corporate debt bubble that was already at historically high levels in 2019. But because the Fed has forced both short-term and long-term interest rates to historically low levels, the cost of servicing this large debt load is relatively low and probably manageable. The Federal Reserve's primary tool to help stabilize the markets has been uncapped quantitative easing. And here we can see the increase in the size of the Fed's balance sheet as a result of uncapped QE. From March to May of 2020, the Fed flooded the debt markets with $3 trillion. To put that number in perspective, the Fed had maintained a balance sheet of under $1 trillion for its entire history prior to 2008. During the Great Recession of 2008 and 2009, the Fed printed about 1.3 trillion and then printed another 2.2 trillion from 2010 to 2015. In response to COVID, the Fed printed $3 trillion in about 3 months. Also, for the first time in history, the Fed bought corporate bonds, including high-yield bonds, which are also known as junk bonds. The Fed's strategy has had the intended effect of suppressing bond yields and forcing investors out of bonds into more risky assets like equities. In addition to uncapped quantitative easing, the Federal Reserve announced a few important changes to monetary policy in August. The first important change is to target an average inflation rate of 2% over time instead of a cap of 2%. The Fed indicated that it would allow inflation to temporarily rise above 2% before raising interest rates and tightening monetary policy. The Fed also announced a policy to mitigate shortfalls from maximum employment. The implication of this is that the Fed is going to target a very low unemployment rate before considering any actions to tighten monetary policy. In the past, the Fed has raised rates in advance of achieving full employment. While they did not quantify the employment target, the implication of these statements is that the Fed will maintain very low short-term and long-term interest rates until the economy has fully recovered. I'm going to let Paul comment on the next slide, which examines the relationship between unemployment, inflation, and the dollar.
Picked up this chart from The Economist here a couple of weeks ago, which published about the same time the Fed came out with their 2 enhancements to Federal Reserve policy, and in particular the one aimed at an inflation target of 2% instead of an inflation cap of 2%, but also related to the employment shortfall targeting as well. And you can see here what The Economist has done is they're pointing out the fact that in the first decade of the 2000s that we used to have a stronger relationship between a low unemployment rate and a higher inflation rate, and that line has been flattening out in the second decade, and therefore it makes sense to allow for just a little bit more inflation because it's not quite as tightly tied to the employment situation and vice versa. Now, for those of you who may have read the details of our paper on our website about the myths and misconceptions of the U.S. dollar, this one does sort of stick in our gullet just a little bit because the Phillips curve, which does put out the relationship between unemployment and inflation, has always been a dodgy curve at best. And in particular, the problem with the Phillips curve is it doesn't really acknowledge the role of the U.S. dollar. The Phillips curve, in our view anyway, plays its most important role when there's no movement in the currency at all. And if you read the Wikipedia on the Phillips curve, you'll see quite a bit of discussion about how the Phillips curve broke in the 70s due to stagflation, which of course you would think when you have the high inflation of the 70s, you'd have low unemployment, and you had exactly the opposite what happened to the Phillips curve. Well, what obviously happened in 1973 is we went off the gold standard and the dollar fell apart, which surged inflation through the system. And probably 8 out of 10 inflationary episodes, not just in America, but in countries around the world for the last 50 years, are actually due to a currency falling apart more so than an overheated economy that would be indicative of a Phillips curve relationship. So to us, if you look at what's happened in 2000 to 2009, well, the dollar was a little bit weak in that period. In 2010 through 2019, the dollar was a little bit strong. That explains the change in the relationship of the Phillips curve. Regardless, does that mean that we disagree with the Fed? No, actually, I think we're on board with the Fed. The fact that the dollar's done what it's done is actually allowing the Fed to move towards an inflation targeting scenario. We could actually use a little bit more inflation because of the fact that the dollar is strong. So anyway, interesting little theoretical discussion going on, one that sort of sticks in our gullet just a little bit because I think the Phillips curve is missing a very important variable, and that's where's the world reserve currency going.
The last few slides have focused on U.S. Federal Reserve policy, but clearly the COVID-19 virus is a global pandemic. The other major central banks have adopted similar measures to support and supply liquidity to capital markets. The chart on the left shows that the U.S. Federal Reserve and the European Central Bank have been the most aggressive with respect to growing their balance sheets, followed by the Bank of Japan. Interestingly, the People's Bank of China has been the most conservative and has not grown its balance sheet meaningfully during the pandemic. Assuming that they are reporting accurate numbers, China has been able to contain the pandemic, is showing very few new cases and new deaths, and its economic impact has been more limited than the US and Europe's. The slide on the right shows that the Federal Reserve and the European Central Bank have taken different approaches. The Fed is focused primarily on asset purchases, while the ECB is focused on lending and credit facilities. The ECB has understandably been more reticent to purchase the government and corporate debt of its member countries and has preferred to lend capital rather than simply buy debt securities. Now, investors who are concerned about a collapse of the dollar are ignoring the fact that the ECB and Bank of Japan are also expanding their balance sheets. Interestingly, the ECB, by lending capital to its member countries instead of buying bonds outright, could be setting itself up for another sovereign debt problem among countries with large debt loads. It is interesting to examine what happened to the $2 trillion CARES Act stimulus program. Less than half of it was actually spent. The savings rate initially spiked to around 30% as consumers drastically reduced spending on travel, restaurants, and shopping at physical stores. This was partially offset by an increase in e-commerce activity and housing demand, but the overall savings rate rose among high-income earners. Schwab, Robinhood, and other retail investment platforms saw record new account openings, and this likely sparked a dramatic turn in the equity markets from April through August. Whether this new money stays in the market or eventually gets pulled out is yet to be seen. We will come back to this issue later when we look at the money on the sidelines chart. As we alluded to in the prior slide, we saw a meaningful portion of the stimulus funds being saved in all income categories, and the rate was particularly high among high-income earners. Households with earnings over $60,000 saved over 30% of their stimulus funds. With the combination of aggressive quantitative easing from the Federal Reserve, as well as the high savings rate among high-income households, both equity and bond markets have been very strong since April, with only minor corrections along the way. And while the markets appear to be disconnected from the underlying economy, the overwhelming amount of capital from both the Federal Reserve and the savings from the $2 trillion CARES Act needed to find a home, and this combination has pushed the equity and bond markets to near record highs. Fed policy, combined with large inflows from retail investors, have broken the historic correlation between the market indices and earnings per share of the companies in the index. Now, it's important to note that this is trailing earnings, and the market tends to be priced on forward earnings. So the market is already pricing in a return to 2019 earnings levels in the future, as well as additional growth from that point. Equity markets are also seeing multiple expansion because normalized earnings yields among stocks are so much higher than bond yields. We'll come back to this point again in a few minutes. This is one of my favorite charts because every once in a while it tells you when you have an obvious buying opportunity. This is the money on the sidelines chart. It represents the cash held in both retail and institutional money market funds. It is the total cash sitting in money market funds earning a near 0% return. The prior peak was in the first quarter of 2009, which turned out to be a historic market bottom preceding a new 10-year bull market. We also saw another peak in money on the sidelines in March of 2020, which also turned out to be a tremendous buying opportunity. Now, some of this money has come off the sidelines and has helped fuel the market recovery. However, the amount of cash on the sidelines is still very high relative to historic levels, which means that investors are either willing to sit on a lot of cash or are waiting for buying opportunities. This is an indicator that pullbacks in the market will probably be short-lived because there is still plenty of capital that is being held in cash looking for a home that can offer greater than 0% returns. How is it possible that we can have a bull market in stocks, bonds, as well as substantial cash on the sidelines? It is because Fed policy, combined with the $2 trillion CARES Act, has pushed an overwhelming amount of liquidity and capital into the system and into the accounts of pension funds, endowments, mutual funds, hedge funds, and other institutional and high net worth investors. Because money on the sidelines peaks during bear markets and then ends up chasing bull markets, bear markets frequently lead to multi-year bull markets. This time does not look like it will be an exception. While the market is way ahead of the economy, the underlying economy will eventually recover and COVID will eventually be behind us. With lots of cash on the sidelines, we may well be at the beginning of a new multi-year bull market. Stocks are a bargain compared to bonds. What we're looking at is a comparison of equity earnings yields and bond yields from 1979 to the present. The equity earnings yield is the inverse of the price to earnings ratio. It is earnings per share divided by the share price. So if the current stock market PE is 21.4, the inverse of that is about 4.7%. This number represents what you would earn if you owned all of the companies in the S&P 500 and you kept all of the earnings, not just the dividends, but all of the earnings. From 1981 to about 1998, these numbers were highly correlated. That correlation broke down during the dot-com bubble of 1999, when Treasury bonds were yielding well over 6% and the average equity earnings yield was under 4%. The subsequent dot-com correction brought these numbers back into balance around 2001 and 2002, but only temporarily. Since then, bonds have continued to rally, and Treasury bond yields at around 0.7% now are at 40-year lows. Equities, on the other hand, are expensive relative to historical levels, but they are yielding significantly more than bonds. So in comparing these two asset classes, equities offer a much better value than Treasury bonds at this juncture.
Seems like when you look at the S&P 500 and try to break down what the hot spots and cold spots are, S&P is, for many years has broken down into sectors, the tech sector and the financials and the energy and whatnot. And so you can get a sense for what it is that people are buying at sort of a macro level, which is helpful. More recently, we've been looking at things like smart beta factors, so growth versus value, or momentum, or high beta, or minimum volatility momentum. Anyway, those growth factors or smart beta factors are another way to slice and dice the market. But in 2020, it seems like the way to slice and dice the market has been basically determining whether you're in a sector that's a COVID winner or a COVID loser. So if you own a Zoom video and it looks like COVID's going to be around for a decade, well, you're going to be in a good situation. If you own, on the other hand, Carnival Cruise Lines, and it looks like COVID just got cured today, well, you're going to see a nice little recovery there, perhaps. Anyway, that's a simple way to look at it, but we'd like to add actually just one other variable to that paradigm, that instead of just looking at it and say, is it a COVID winner or a COVID loser, but we would like to look at, is it currently a COVID winner, but will it stay a COVID winner, and vice versa, or is it currently a COVID loser and stay a COVID loser? And so on the top left, we've got those ones that are short-term gain and long-term gain, and we put Zoom video in that category. If they cure coronavirus tomorrow, okay, the growth will slack off, but it's not going back to where it was before. It's just not. And vice versa, if on the bottom right-hand quadrant, if they cure coronavirus tomorrow, does that mean everybody jumps on a cruise boat? No, I think everybody's kind of worried about it. They will see an increase in demand, but it's not going back to where 2019 was. In fact, Airbus went out just here recently saying that air traffic in general is not going to return to 2019 levels until the year 2025. And so that's a short-term pain and long-term pain for those travel-related destination travel industries. But in a way, the more interesting ones are actually that top right quadrant and the bottom left quadrant. If you look at the For example, the toilet paper industry, like a Clearwater paper or a Cascade of Canada. Um, Clearly, we've seen quite a bit of consumer stocking, and so the revenues pop because of the consumer stocking, and they've done very, very well making tons of money during that consumer stocking period. But the revenues don't return to normal when you get past COVID. Instead, they go below normal because everybody has to destock the channel. And that destocking can run for a long time. So you can run from maybe 100 million in revenue, you get COVID, it goes to 130 million in revenue. It doesn't go back to 100 million in revenue. Instead, it goes back to 70 million in revenue. It gets cut in half practically. And so a lot of those businesses, oil tankers and vaccines, they're not necessarily playing on the inventory cycle, but there's something about them that makes a situation kind of long term fairly difficult. Uh, just the exact opposite in the top right quadrant, for example, in the orthopedic space, where we see like artificial hips and knees, those are clearly a deferrable surgery, but the baseline demand continues to grow as people get old and people get arthritis, and maybe there's some trauma, car accidents and whatnot. There's always a baseline demand for those things, but the people that just defer for a year, the baseline demand is still growing. So your revenue will go from 100 million down to maybe 80 million. Then it goes back to normal a year from now, plus the baseline. So it pops to maybe 105 or 110, plus all the return of the 20 million that didn't show. Suddenly you're at 130. And so you go from 80 to 130 in the space of 18 months. And so it's an interesting setup here that it's a little bit of an oversimplification to just say COVID winner versus COVID loser, but you really have to look sort of, is it going to stick with you for a while, or is it going to reverse, and is it going to reverse and you get a double whammy or a double benefit? And so anyway, that's kind of the paradigm that we're looking at things and how things are shaping up during COVID. And that does seem to be the way that folks in general are looking at the market. They're looking at COVID winners versus COVID losers. They're not necessarily looking at this next layer, but that is sort of the way to look at it. And I move topics here over to the election, since this is an election year and it's only a couple of months away from us, just under a couple of months now. We've given this chart in prior slideshows and just shows basically the average election year is return is very close to the non-election year. Not a whole lot of difference, but of course in any given year there's quite a wide variance, and obviously that's just recognizing the fact that there's a lot more to an economy than just the presidential election. Indeed, the economy is more complicated than a presidential election, as we just seen on the prior slide. That said, a presidential election is a major headline generator, and so we inevitably get questions from our customers about what types of stocks and what types of sectors might do well under a Biden presidency versus a Trump presidency or re-election of a Trump. We have a tendency to demur from that particular question, and indeed, we've actually published a little bit on this particular topic in general, and it's actually on our website, cedarrivercapital.com, a paper there titled The Dull Blade of Occam's Razor. It's fairly lengthy, about 45 pages, but the long and short of it is that the idea that the president somehow controls the economy or the stock market is the number one myth on Wall Street. Bill Clinton didn't really create the dot-com bubble. George Bush didn't really create the subprime crisis, and so on and so on. They just happened to be the figurehead that was sitting in the hot seat at the time when the economy did what it was going to do anyway. So, but that said, perhaps slightly cynical, but I also think very realistic. Uh, we still need to answer the question to customers that, what do other people think will happen under a Biden presidency to the various stocks and sectors, and same thing with the Trump presidency. And so what we've done here on this slide is we've curated a couple of lists, just basically taken from other sources, the Wall Street Journal, Kiplinger, CNBC. Barron's in particular has written quite a bit on this. And what other people believe is that under a Biden presidency, that will be good for renewables. That could be like a solar, or it could be wind farms. Cannabis will be a beneficiary. Electric vehicles, that could be the Tesla, as well as the new competing SPACs like Nikola. Health insurance, tailwind, REITs, which had a bit of a headwind, may see a reversal of that headwind if the taxes go back to where they were before. China stocks and Mexico stocks, both geographies that were under pressure under Trump. Under a Biden, they could see a relief of pressure from that change in the Oval Office. On the other list, if Trump wins, continues his 4 years to 8 years, banks come on the list as a possible beneficiary with his aim at deregulation and some of the tax breaks and whatnot for the banks. The oil industry, of course, Texas is a big red state voter for Trump, and so Trump needs to support the oil industry. Social media, Twitter, of course, comes to mind right at the top of the list, but there's more than just Twitter. National defense, so the Raytheons and the Lockheeds and whatnot. Infrastructure, of course, has been part of the plank for some time. Russia stocks, not necessarily because Russia is throwing the election one way or another, but because Russia is basically an oil state, just like Texas. And so if Trump does something good for Texas, Russia has it also benefits. Firearms, of course, that's also part of the plank. So this is essentially what I would regard as street consensus of what would happen with Biden winning, what happened with Trump winning. Again, they do not reflect the opinions of Cedar River. Some of these we may agree or disagree with. Our own interpretation of individual stocks is just a little bit more complicated, and the presidency is basically a bit player in many of our individual stock picks. This slide is from a recent poll of the upcoming presidential election, Biden versus Trump. This particular poll came from The Economist, July 14th. So it's about 7, almost 8 weeks old now. It's a little bit aged. That said, most of the polls we've seen recently are actually not too different from this one, and we actually liked the visual of this particular one with the state-by-state breakout, and so we've decided to incorporate this one into our slide deck for the presentation today. Now, I know in our last couple of slides, we talked about the fact that presidential politics don't play a huge role in our investment process. That said, our presentation today is titled Market Touchstones, and the presidential election, of course, is a huge touchstone. It's something that everybody must deal with. Everybody votes, and so we all have to talk about it. So therefore, it's a very big touchstone. When you look at this slide in this picture in particular, you can see probably what you'd expect in the sense that the coastal states are generally leaning towards the left, and the center of the country states are generally leaning towards the right. But the real focus is really on the battleground states, if you will, is really going to be the undecided states, the ones that are circled in white. There's 5 of them here: Arizona, Iowa, Ohio, North Carolina, and Georgia. And probably one tier down from that, those that are just off of the uncertain category. And Texas is leaning just a little bit to the right. Wisconsin, Pennsylvania, and Florida just a little bit to the left. And so those could be your second tier battleground states for this upcoming election. There's about 7 weeks to go before the actual election itself, and there's a lot that can change, in particular, just in the last week or two before the election. A lot of voters, well, they don't have necessarily the longest attention spans, and so a lot of information will get pumped out in that last week or two. Makes me, as well as Baj, I think we're both reluctant to forecast, just because Biden is ahead in the polls means that it's a Biden landslide coming. A lot can happen in those last couple of weeks. Anything can happen. In fact, that is the title of our slide today. Biden presently ahead in the polls, but anything could happen, and that that voter turnout in the swing states will likely determine the outcome of the election. Our slideshow today is mainly focused around Fed policy and, of course, the COVID-19 pandemic that led to the Fed policy, and, of course, the market reaction to both COVID-19 as well as the Fed. We've also talked about presidential elections, and we've talked about which sectors will have been doing well or doing poor amid COVID, and stocks versus bonds, asset allocation. This last slide, however, I would regard this as a cleanup slide. These would be, I would regard, level 2 second tier market touchstones. These are all important, but not quite at the level of importance of Fed policy. Let me start off actually with the very first one here, the very sharp Q3 economic rebound that's expected. Consensus right now is plus 25%, which would be an unprecedentedly strong number. Of course, that is following the Q2 GDP number, which was unprecedentedly weak at minus 32%. So some people are just kind of lumping those two together and saying, well, we're about 3/4 the way recovered from where we were in Q1, which is, I think, probably not a bad way to look at it. But there is actually one other ramification to this GDP consensus being so strong. And in particular, it's related to the definition of recession and the headlines around that. From a very simplistic level, most people regard a recession as two consecutive quarters of negative GDP growth. And we've seen that. Q1 was minus 5%, Q2 was minus 32%. But if we get plus 25% in Q3, we've then moved from recession to recovery quite fast. But the timing of that announcement is literally days before the election. It's tail end of October, right around Halloween, and so you just know that this is going to be political fodder for incumbents versus challengers, whether we're in recession or in recovery. We still, just for the record, don't have a formal declaration from the National Bureau of Economic Research as to whether we're actually in recession or not. So anyway, it should be interesting from in particular, just from a headline perspective. Let's move on to the second item, the weak dollar. Trade-weighted dollar is down about 10%, not quite 10%. A big part of that, probably 2/3 to 3/4, that move is simply reversing the flight to safety that we saw during March. Currency markets are probably no surprise that the US dollar is perceived as sort of the blue chip currency. It's the low risk currency that everybody bases valuation upon. Whereas if you're in maybe Brazilian real or Indian rupee, or maybe even a further frontier market out of, Ghanaian cedi or something like that, uh, folks have a tendency to dollarize their economy, buy dollars during periods of pandemic or crisis, whether it be the 2008, 2009 recession or some sort of military threat. Flight to safety is a very common phenomenon in the currency markets, and that was the bulk of what's been going on. Strength of the euro has actually been a little bit more of a beneficiary of the weakness in the dollar than other currencies, and so there's some Europe-specific phenomenon that's actually benefiting the euro, that's actually weighing on the dollar a little bit more than it should be. So a little bit of that dollar weakness is actually just simply euro strength. Might also mention one other item not on the list, but currency traders do have a tendency to be momentum oriented, and sometimes once the dollar starts to go weak, the weakness can beget more weakness, and so I think there's a little bit of that going on as well. Is that going to continue on? I actually kind of think we're mostly done with the dollar weakness now. I think we're more just in a trading range, and part of that is because the flight to safety is mostly reversed and it's gotten a little ahead of itself now. And so euro right now is trading at about 118, 119. We might see 120, 121, but I think it's more likely we just stay here just sub 120 for the next probably balance of the year. Let's move on to this third item, the tech correction, another one that's sort of gently in the headlines here recently, and it's mainly just in the month of September, so this is not something that's been going on for months, it's more just in the last few weeks. And in particular, essentially what's going on is a lot of the tech stocks, the NASDAQ stocks, have been underperforming the S&P for the last few weeks. But the reality is that there's probably an overdue correction there. The tech stocks did much better coming out of the March lows, and so they're ahead of themselves, and so they're overdue for a correction. Now, there are a couple of other things that are sort of going on in the background there too. I think probably high on the list, we did see, Tesla actually did a secondary offering in end of August, early September, and that always raises the question: hey, if they're selling, why am I buying? And so that was one of the leaders. It's not up to the market cap of the big five tech names, but it's a high profile name, and one of the highest profile names has a little bit of setback like that does sort of taint everybody else. The other thing that's going on in the background too is that we're in an election season, and the big five tech stocks also can be political fodder. All five of them have had antitrust directives aimed at them, and not in a way that sticks, but as we get close to actual elections, it's there will be politicians making speeches about regulating one or all of the big five tech names. That's just part and parcel of that industry. We saw it in the 2016 elections, and we're probably going to see it again here in coming weeks. Longer term, still bullish. I'm still bullish. Baj and I are both still bullish on tech stocks, and so we think okay, maybe a little bit of choppiness over the next few weeks, maybe a few months, but next few years, not too worried. Let's look at this fourth item on China trade, and we've talked about this in our prior slide deck, saying that it's kind of a game theory result for China to just do nothing until we know who's actually going to be in the Oval Office in November, and that's been the strategy for over a year. And so the closer we get, the less and less news there is to report. The only news that we have is maybe U.S. asking for concessions on various trade, but there's not actually a meeting at the table for anything. So not going to be a whole lot of news to report until the election, and then after the election, it'll probably depend on who's actually in the Oval Office, and so we'll probably just sit on the sidelines there. Last line item on the high debt levels. Again, we also chatted about this in our prior slide deck. Clearly not something that's weighing on the market today. It's something that's in the headlines, of course, because the The $2 trillion CARES Act is just another line item that is effectively breaking the budget. And of course, that was not too long after the 2017 Tax Cut and Jobs Act, which reduced the revenue to the IRS, and so the deficits are widening significantly, which means the debt levels are going to be widening significantly. And that 130%, that's roughly consensus, plus or minus a few percentage points for next year. And next year is not going to be the peak; it's going to keep creeping, even with the economic recovery. So that's not really a problem for Wall Street, but the high debt levels, yeah, that is a problem. Not necessarily for us today, but again, maybe for the next generation, that could be an issue. I don't want to leave this slide on such a low note, and so I do want to mention just one other little small silver lining here, and that's that the debt levels may be about twice what our average is over the last 50 years, and reaching near a high since World War II. But the interest rates are basically near zilch with the Fed rate, Fed policy, damn near zero interest rates. That basically means, okay, the debt burden is high, but the interest burden is actually not that bad, not as bad as it would suggest. So small silver lining, and still something to worry about, but maybe not quite worry so much to lose sleep over. Thank you again for listening to our Cedar River Capital Mid-Year 2020 Market Touchstones Report. Please feel free to reach out and ping us if you have any questions or comments. Please take a look at our website, cedarrivercapital.com. And again, thank you for listening and thank you for tuning in.